Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders. The title of the video is Know Why the Third Elliott Wave Should Not Be the Shortest Wave. Okay, in this video we want to discuss why, according to the wave principle, the third Elliott wave should not be the shortest wave. Okay, when we are using the Elliott wave, we must understand, okay, the Elliott wave rules. Okay, one of the Elliott wave principle is that the third Elliott wave should not be the shortest wave. Okay, now the first thing that, because the reason why we are recording this video is that when a trader understands the wave principle, he or she can use the wave theory more efficiently. All right, so it is one thing to know, it's another thing to understand. Okay, one can learn something and know about it, and one may not understand it. Okay, so to know is not to understand. So in this video, we want to clarify one of the wave principles that states that the third Elliott wave should not be the shortest wave. There are another wave, principle, Elliott wave theory states also that the fourth wave should not overlap the first Elliott wave. I will be recording another video when I will explain to traders why the fourth Elliott wave should not overlap, okay, the first Elliott wave. So in this video, we want to concentrate on the third Elliott wave. Okay, the normal Elliott wave progression is that we have the first wave, the second wave, and very often the third wave is the longest wave, followed by the fourth wave, usually a shallow Elliott wave, and the fifth wave. But sometimes the third Elliott wave is not the longest wave, but according to the Elliott wave theory, the third Elliott wave should not be, okay, the shortest wave. Okay, so here we want to know why. So when we understand why, we will be able to apply, okay, the wave theory, okay, like a professional trader. Okay, all right. So here I draw the normal Elliott wave. You see the first wave, okay, is shorter than the third wave, all right, right here. And you can see that here I have drawn the third Elliott wave, that is the longest wave. When we are talking about the third Elliott wave, shouldn't be the shortest wave. Now we want to understand what are we talking about, okay? Are we comparing the third Elliott wave to the second wave, or to the fourth wave, or to the fifth wave, or to the first wave? When we are saying that the third Elliott wave should not be the shortest wave, we are comparing the third wave to the first wave and the fifth wave. That's it. Because the first wave, the third wave, and the fifth wave are what we call the impulsive waves. All right. So when we say the third Elliott wave shouldn't be the shortest, it shouldn't be shorter than the first wave. It shouldn't be shorter than the fifth wave. That's what we meant by the third wave should not be, okay, the shortest wave. Okay. But there are more to this. Why the third wave? Why? That's the good question. All right. When a trader starts asking question why, you know that the trader wants to understand something, okay, or the trader wants to master, okay, the tool. So you can use MACD, you can use stochastic, you can use CCI, but the best way to use this technical tool or any other trading tool more efficiently is to understand the tool. So some traders know about MACD signal, MACD signal line, MACD zero line, and MACD itself. They know about MACD divergence, but they do not understand MACD itself. When a trader finally understands MACD itself, he or she can use MACD more efficiently. The same thing applies to the stochastic, the RSI, or any tool that we are using in the financial market, the Fibonacci arcs. Okay, we want to understand what is the Fibonacci arc. Okay, it's wanted to know about Fibonacci arc. Okay, this is why we are recording this video today. All right, very, very important. Okay, so here I draw the first wave, which is the gray line here, followed by the second wave here, and okay, the third wave is the shortest wave. You see the red line here, it's a shorter compared to the first one here, as you can see. You see on my chart, if you compare the red line to the green line, the red line is shorter than the green line. So here the third wave is shorter than the first wave. This is a violation of the wave principle. If I compare again the red line to the orange line, which will be the third Elliott wave to the fifth wave, as I draw it here, you can see that the red line is shorter than the orange line. So here I have a distorted Elliott wave pattern. This is not, okay, a motive wave, because according to the wave principle, the third Elliott wave should not be the shortest wave. So sometimes you may count waves, say 1, 2, 3, 4, 5 Elliott wave, but if your third Elliott wave is shorter than the first and the fifth wave, you know that, okay, you are not dealing with, okay, the normal motive wave. The motive wave is formed of the first wave, second wave, third wave, fourth wave, and the fifth wave. So you know that there is a violation of the wave principle. This is not a motive wave, probably a corrective wave. So the third Elliott wave, according to the Elliott wave principle, shouldn't be shorter than the first and the fifth wave. That's what we meant by the third wave should not be the shortest wave. All right? But here, let me explain something to you. So you can see, so very often for traders that are following our guideline, we know that usually we have a downtrend, okay, and then a consolidation before we have a bullish, okay, Elliott wave cycle. So the Elliott wave cycle is formed of the motive wave and the corrective wave. So suppose we have a downtrend, okay, so we see a downtrend like this, okay, followed by a consolidation, all right? If, for instance, here, suppose I put my consolidations here, all right? So we see consolidation, all right? Suppose there was a downtrend here, all right? Downtrend, I put it in red, all right? So now we have, okay, the first wave, which is the green line, come out of the consolidation zone. If the third wave is the shortest wave, what will happen, all right? So traders that were selling before, so the market was saturated by the bear, okay? So the dominant force in the market before the first wave, in this case right here, was bearish, okay? So people were selling, everybody was selling, and then suddenly we have a consolidation. Now we have the first wave followed by the second wave. But now if the third wave here is shorter than the first wave, what will happen? Think of it, all right? Whenever we see a bullish progression, first move, second move, and the third move is shorter than the first move, is bearish. Are you with me? So, for instance here, if you were here and we see the first wave like this, and the second wave, and the third wave like this, shorter than the first wave, what will happen is that the price here, at this point in time, the fourth wave will not be shot up. You'll see that people will tend to sell. It's a kind of capitulation here because this is the first invitation to buy after the first wave. So there was a first wave, there was a bearish season a long time, and then we have a consolidation. Now people think that a new trend has begun, and then we have a pullback. This second wave is the first invitation to buy. So the smart money was buying during the consolidation period, all right? And now we have the first wave breakout, a pullback, which is the second wave. Now, if the third wave is shorter than the first wave, it's bearish. This is about the language of the price. It is bearish. The trader that understands the language of the price and the bear that was selling before will not hesitate to sell the financial instrument if the trend line along the third wave here is broken. So if the third wave is shorter, than the first wave, in this case, you will see that the bear will respond and will come back big time to sell the financial instrument. Big time, all right? They will sell it big time. As you can see, the progression wouldn't be too far, won't be too strong. It's not too strong. So what this principle is telling us is that during the third Elliott wave, okay, the momentum should be strong. That's another way to interpret the theory that is stating that the third Elliott wave shouldn't be the shortest wave, which means after the first wave and the second wave, if there is more buyers in the market, we should see a stronger bullish momentum. But if the bullish momentum is not very strong and the third wave is shorter than the first wave, we are likely to see a reversal. This is one reason why the third Elliott wave should not be the shortest wave. There's another reason. Let me explain another reason for you. We also know that there's another Elliott wave theory that stated that the second wave should not cancel the first wave. So we shouldn't expect the second wave to come to the starting point or go below the starting point of the first wave. So suppose we have a second wave that went a little bit deeper, okay, like this. Suppose it went down deeper like this, okay? All right, so this is my first wave, and the second wave in this case went down too far. Okay, suppose you went to the 61.8% or 78.2% of the first wave. All right, if our third Elliott wave is shorter like this, as I put it now in red, all right, what will happen? We will see a pattern like this. So we'll have some. So suppose the second wave went down too far, and the second wave and the third wave is shorter than the first wave. You will see something like this. All right. So because the second issue went deeper, we see a pattern like this, which will not be an Elliott wave pattern. So we have second wave went a little bit deeper. Even if it went down deeper, okay, we will have something like this. So the third Elliott wave may not even go above the high of the first wave, which will create a bit of distortion. So for those reasons, that's why the Elliott wave stated that the third Elliott wave should not be the shortest wave. All right. So the first reason is that because the second wave, when the second wave is completed, is giving us the first invitation to buy. So some traders were buying before, all right, and then we have the first wave after the longest downtrend. Okay, so now we have an invitation to buy. Price pull back, people are buying. If okay, the bullish momentum is not very strong, and the third Elliott wave is shorter than the first wave, there will be a capitulation of the trend, which means the bear will come back and sell it because they know that, well, the first invitation, okay, not many market participants responded to the invitation to buy. So that will put, okay, the whole motive into question, which means we will not have a proper trend, all right? So what we are saying also, when we are saying that the third Elliott wave should not be the shorter wave, we are also saying that if there will be a proper trend, after the first invitation, the following move should be stronger than the first move, all right? So in a normal trend, if we have a first move followed by a pullback, the following move after the first invitation to buy should be longer than the first move. That will give market participants more confidence to participate in the market. Also, if the third Elliott wave is shorter than the first wave, it is telling us that maybe the fundamentals are not solid, or there was some weakness in the fundamentals. That's why the market participant did not continue to buy the financial instrument. The opposite is also true in a downtrend. So in a downtrend, the third Elliott wave in the downtrend should not be the shortest wave, okay? So in this scenario, what I have shown you here, you can see that if you have a first wave like this, and we have a second wave that went down too far, if the third wave is a little bit shorter than the first one, okay, we will have a kind of a funny, okay, pattern. So we'll have something like this: first wave, second wave, third wave, fourth wave, fifth wave. This has nothing to do with the Elliott wave pattern. In order, okay, to have, the trend and the price staying in a rising channel or even going above the rising channel, it is important that the third Elliott wave, okay, is not the shortest wave. In this example, I was telling you that, okay, so we can show another example now when we have a second wave, all right? Suppose we were here, all right? Okay? So if the third wave is the shortest wave, it will be shorter than the first wave and also shorter than the fifth wave. You get that, okay? So we have something like this, okay? Very often, if you see this like this, if you see the third wave shorter like this, you know that this is not a proper motive wave, straight away. But also, if you have a first move, all right, let me show you one example here. On the chart, this is the language of the price. Very often, what is one example I can show you now? Look here, look at this one here, okay? So you see this move here, price went up big time. Yes, you see? So if you count this, for instance, this is nothing to do with Elliott wave, but I want you to understand what is happening through the mind of the other trader, the interpretation of the price or the price analysis, okay? So if you call this like first wave, and then we have a pullback like this, okay? You see, because this is an invitation to buy here, bullish move, invitation to buy. But look, as the price was going up, this second move is shorter than the first move, is bearish. You can look for this setup on any time frame. We can interpret the wave principle to dictate, okay, distortion and also excellent trading opportunity. If I was here, I will sell this financial instrument here. As soon as, okay, this trend line here is broken, I will use my trading drill, okay, set up, signal, low risk entry point, and I will sell because the second move, the second impulsive move, okay, is shorter than the first one. So you see people were buying strongly here, and then there was a first invitation to buy. After the first invitation to buy, we will expect the price, if the market is very, very enthusiastic, okay, so to speak, to buy, you should have more buyers because there are first buyers and the first invitation, okay, will bring into the market new buyers. But if we see that after the first invitation, there were no more buyers, okay, okay, it's a weakness. We look for opportunity to sell. Yeah, I will sell, okay? All right? All right? It makes sense? It makes sense? Look at this one here. It's not a very good example in a downtrend. It's not a very good example. She probably went down big time up to here. Okay, so the dominant force in this session were bearish. Okay, so now it rally. Okay, now if the common central line along here is kaput, so to speak a bit of German to my friend. All right, though I don't speak. All right, I have people in my family that speak a lot of German, but I'm not very good. Okay, so now if we have okay, if this trend line here is broken, this is an invitation to sell because the dominant fall, the prior move was bearish, the dominant fall is bearish, we have a rally, okay, that did not go above the 50% Fibonacci retracement level of the prior move. The common central line is broken. It's a bearish setup. We use the trading drill, okay, to enter the market. Now you see the following move. Look at this one. It's not very strong, but it's almost equal. That's what I'm saying to you. It's not a very good example. But suppose this following move was shorter like this. If it was shorter, okay? So this is my first invitation to sell here. Bearish move. First invitation to buy, to sell here. Common central might be broken. The common central might be broken. And we apply the trading drill. And we will check the fundamental, okay? All right? So if, for instance, we assume that this... okay, next move is shorter than the first bearish move, is bullish. You should be able to detect that, okay? So if the price stop here, I will know that there's a high chance, okay, that the price, look at this one, this is another one, this is another example. Okay, here, there's a better example here. let's pay attention carefully, okay? Because I want you to understand why the third Elliott wave should not be the shortest wave. I don't want this video to be too long. I've been talking to you now nearly 20 minutes, okay? I think I will stop here. I hope you have learned something from this video also, and we put into use, okay? Now, I'll let you continue because I don't want to stop like this, okay? Let's continue, all right? I hope you like it. So now, look at this one, okay? I did not want the video to go beyond 20 minutes, but okay, let's continue, okay? So look at this one. See here, now there was this move, okay? A rally a little bit, not over the 50%. Look at the following move, all right? Down, okay? If this is an invitation to sell after this move, bearish move, rally, common center is broken, use the trading drill, invitation to sell, you will sell. Now look, the following move was not very strong. Compare this move to this one. It's a bit shorter. It's bullish here. It's a bullish setup here. If it is a bullish setup, if this trend line here is broken. Yes, people were buying here, you see. You must buy. You must take, if you were selling and you see that, you must come out of your trade. Because bearish move, invitation to sell, the second move is no longer than the first one, and the trend line here is broken. If you were selling, come out. All right? If you don't want to buy, come out. If you don't want to look for opportunity to buy, come out. Okay? Doesn't mean that this thing will go up. But I want you to understand the principle, the wave principle, why the third Elliott wave should not be the shortest wave. All right? So, as the bull that we're buying here, first move, pull back. If this is shorter than the first one, the bear that understands the language of the price will come back big time, will try to sell, and there is a high chance that instead of having a normal fourth wave, the price may come back down and capitulate completely. All right? You need to understand that. Also, because this is the first invitation to buy, if there are more buyers, the bullish momentum should be stronger. All right? But because you see, there is the first bullish move is the first one, okay? Followed by the second one and the third one, okay? So it doesn't make any sense in a normal trend that the first invitation is shorter than the last move, okay? It doesn't make any sense, okay? It doesn't make any sense. We know that the first wave and the third wave and the fifth wave can be extended, but the third wave should not be the shortest wave, which means the first wave can be shorter, okay? So the first wave can be the shortest wave, and the fifth wave also can be the shortest wave, except the third Elliott wave, because the market pattern will be violated, which means, you see, the way I'm drawing here, you see that my price is inside the pink channel, even going above it. This is a strong bullish trend. But if, for instance, the third wave is shorter than this, the market pattern will be violated, meaning that the price may come out of the channel, okay, and maybe even collapsing altogether, okay, which will violate, okay, the Elliott wave principle. All right? Another reason why the third Elliott wave should not be the shortest wave is that if, okay, like I draw it here, okay, let's put it back. I hope you are following me. Okay, I go back to my drawing, okay. Suppose we are here in a short wave, okay. Let's push it up a bit, okay. Pay attention, follow my cursor. Have too many drawing, but I want you to stay focused, okay. All right. So suppose I have something like this, okay, where the third wave is the shortest wave, okay? All right? We can use the Elliott wave principle, okay, to analyze the price, okay? We can dictate the distortion. We can see excellent bullish setup by knowing straight away, because this is a principle, like the third wave should not be the shortest wave. It's telling me that, like I apply here, okay, just looking at the price, if there was a move and there was a rally in a downtrend, and the following move is shorter than the previous move, it's a weakness if the common center line is broken. The same thing applies if in an up move, we have the first move, a pullback, and the following move is shorter than the previous move, is bearish. So a bearish pattern is something you can see if you see something like this, okay? You see something like this, especially on the weekly chart, monthly chart like this. Okay, you see like this. There was a move like this, followed by another one like this, which is not completely 100% retracement, and then the following move is shallow. TSTWSY is your trader is shallow, and the common center is broken. It's a bearish setup. Apply the trading drill, the setup, the signal, and the low risk entry point, any time frame, and you apply your trading drill. All right. The opposite is also true. If in a downtrend we see a move, as I show you here, down followed by a small rally, okay, you see something like this pattern, here. This is about the language of the price. The area weight theory allows us, okay, to interpret the language of the price more clearly. So in a downtrend, you see like this, it went down, invitation to sell, and the price, the following move is shorter than the first one. It's shorter than the first one. That's not sufficient. The common center line here is broken. Doesn't mean sell. It means a bullish setup. So what you will do, you will draw a warning line there, and then you apply the trading drill. If the price dip below the warning line, let it go. Don't force it. All right? But so far, if we see that this down, rally, and the following move is shorter than the first one, and the common center is broken, draw your warning line. This is a bullish setup. Use the trading drill. So as I was explaining to you now, okay, because though TSTW24 and the TSTWSY is your 8 use, okay, technical indicators, what we are trying to do, we are trying to draw traders' attention to the price. Now, some traders ask me, oh, do you use area wave in your system? No. All right. But if you understand area wave, you can use our system more efficiently than other traders. It doesn't mean that traders that do not understand area wave cannot use our system, but it means that it is important for traders to understand the language of the price. Okay. So instead of focusing too much on indicator, we are slowly. As traders ask questions all the time, they will notice that in all my reply, I'm spending most of my time talking about the price than the indicators. The indicators give us warning, but the price will give us what we call the direct signal. So another thing I was saying to you here, the reason why the 30-day wave should not be the shortest wave. Ladies and gentlemen, let's continue this discussion. All right. By the way, if you like this video, give us the thumbs up. If you dislike it, please put a comment. Say, George, you say okay 200 times or something like that. All right. Put a comment below. We can read it, okay? I read all the comments, okay? I'm a bit slow to reply to comment, but I'll read them, okay? All right. So now, another reason why the third area wave should not be the shortest wave is that if the third area wave, now I'm moving my fifth wave away a little bit, is the shortest wave, there's a high chance that we will have another violation of the wave principle. Which one? Which means, because traders that understand the language of the price, they see like this, and they see the first move followed by the second move, and the third move is shorter than the first move. All right, they will respond to sell. Professional, they know they will respond to sell. They will know that it's a bearish setup. It's happening all the time. All right, it's happening all the time. Look, there's one here. Can you see on the chart? We on the 2 days chart here. Look, this move here, it went up. Okay, that's why I want you to get it right. Yes, TWS is usual 8 traders, advanced traders, okay? Get it right. You see here? Here it is. This move, and then pull back. This is shorter. Now what has happened here? The trend line is broken, yes or no? Very setup. Look, it went down, yes or no? You will keep doing this. There's another one here again. Look at this. All right? I don't want to move that, okay? So you see, there's another move here. Look, another bullish progression. Nothing to do with area wave, but this is about to interpret the price using this principle that we are discussing. So you see here, there was this long bullish move, a pullback, but look, the response is shallow. And also, look at that, the common center line here is broken. It's a bearish setup. If you use your trading drill, use the TSCW as usual, like a professional trader, use the TSCW24 like a professional trader, yes. Draw your warning line. I like that, okay? Draw your warning line. That will allow you to control your risk. So if it goes above, find a support, forget about it. Don't fight it, okay? Don't fight it, okay? All right? I'm saying this to new traders. So if you sell here, your first target, trader was asking me about if we tell traders, we tell them how to play their stop loss, whether we tell traders where they should place their stop loss. We do not, because all traders do not have the same trading style. They do not have the same risk tolerance. So when I'm writing my trading system, I don't say to trader 50 pips stop loss. Hey, it's crazy. You can't do that. Because some trader will say to you, you asking me to place 50 pips stop loss? That's crazy, George. I don't want you to use 50 pips. What are you going to do? All right, so we don't say that. All right, so now, so if the price coming down, your first support, your first target will be the first and nearest support level using the language of the price again. Price going down, price looking for a better support level. Okay, so you see now, so it's happening all the time. It's all based on the fact that the third Elliott wave should not be the shortest wave. All right, but this is just about analyzing the price based on what we are discussing here. So if the third Elliott wave, so I'm back here, first wave, second wave, third wave, fourth wave, and a fifth wave. In this case, I make my third wave the shortest wave, okay, which it shouldn't be, okay, compared to the first and the fifth, okay. So one of the reasons why also the third wave should not be the shortest wave is that when traders see this like this, they will respond and sell. And what will happen that it will happen that the fourth wave will overlap the first wave, which means the fourth wave, this is another violation of the wave principle. If the third wave is the shortest wave, there's a high chance that the fourth wave may overlap, okay, the first wave, because trader will see this as a bearish setup if the common central line is broken, and they will respond to sell, and the price may go down and go into the range of the first wave, because one of the Elliott wave principle stated that, okay, the fourth wave should not go in the range of the first wave. So it always together. So the third wave shouldn't be the shortest wave. Also allow us to apply the next rule, which is saying that the fourth wave should not overlap the first wave. It makes sense? Okay, there are more we can say about this, but this is the most important thing that you need to understand when we are talking about why the third Elliott wave should not be the shortest wave. All right, I'm going to bring on another financial instrument now, the Australian dollar, and I'm going to go now on the weekly chart, and I want to show you, I'm looking for a better chart. Okay, I'm looking for, hold on a second, I want to show you another example now, and so we can wrap this up straight away, okay? So I want you to get this into your head, especially TSWS is your 8 traders, okay? So one thing you need to understand, okay, if we see one move, so here you see, this was a bullish move. Are you with me? Okay, I'm here. Are you with me? Here. Bring it to the middle. If you like, we can zoom into it. Hold on a second. 1 second, please. 1 second, please. 1 second, please. I'm coming up, okay? So I'm here, okay? So this is a bullish move, yes or no, okay? You will see all the time, okay? So now you can swing trade like a pro, yes or no. So you pull back. This is what? An invitation to buy. A bullish move, a pullback, okay? And the common central is broken, an invitation to buy. Look the response. After an invitation to buy, check, analyze the response. Look at the response. It's shallow. Look at this. It didn't even go. Look at this. It's a very short. Even 3 times the first move. It's a weakness. All right, you see now? So what you will do, as a TSWS usually trader, you just, the common central is violated, which means here I'm on the 3 days chart. Okay, in this case, if I wait for the first candle here, you see it's quite bearish to completely close below my common central line, it will be too late. At this point in time, I may switch to the daily chart because I'm on the 3 days chart. I will switch to the daily chart. I will allow at least one daily candle to close, okay, behind my common central line. So that will give me a bearish setup. Okay, now I go to the TSWS usually a signal time frame and monitor what is taking place. Is there a signal? Yes. Now I will use the TSTW key 02 to enter the trade. But before that, I will check the economy news. I will use the trading drill, okay, like a professional trader. All right, it makes sense? It looks simple, but practice will make you perfect, okay? This is the end of this video about know why the third Elliott wave should not be the shortest wave. The reason why we record the video is that understanding, okay, is the key to successful trading. If you are using any trading tool, you are using any trading system, that's why we say to traders, ask questions, all right? There's no stupid question. Ask questions, okay? Ask specific questions. I like that, okay? Ask questions. Once you understand it's improving, you will start making better decisions. But while sometimes traders are rushing because traders were losing before, now they want to improve, but they want to improve in one day. No. If it took you 3 years, okay, you were messing around for 3 years or 5 years, you're not going to change everything overnight, okay? Be patient, start afresh, build a better foundation, just keep improving. Maybe you may stop trading, but you're just working on your skill, okay? Gently. Okay, that's the best way forward, okay? And once you understand this, it sticks into your mind, and when you are applying the wave principle, you make excellent decisions. Another thing that is also important that I have to say here is that when you understand this thing, you are likely to count the Elliott wave more accurately. You will also be able to detect distortion that are taking place in this market and know straight away that this is not right. Well, this is a bit, okay? Look at this one here, okay? All right? Look at this one here, okay? It makes sense? Look at this one, okay? All right? Look at this move here, okay? See this move? Very strong move, yes or no? Bullish move, okay? Look at it. And then the price pull back, yes or no? Okay? Look at the response. Look at the response. Huh? You see now? Look at the response. 4, all right? Common center is broken. Use the trading deal. Use the TSW SYS 008, all right? All the time is happening in an uptrend, in a downtrend, based on the principle that we are discussing here about the third Elliott wave should not be the shortest wave. Because if some traders were buying before, the first buyers are the one that generated, okay, the first wave. They are in the market. All right? These are smart money. They know that these stocks should go up, so they buy. And everybody see the first wave. Not everybody will catch the first wave, but most people catch the third Elliott wave. But if the third Elliott wave is not dynamic, is not strong, it happens to be the shortest wave, the trend is not going to go too far. The first warning that we have is that if the third wave suddenly happens to be shorter than the first wave, we start going back to Google Finance, check the fundamental and say, why now the third wave is shorter than the first one? So we will say, okay, probably if we go back and check the fundamentals, and the fundamentals are solid, the market environment is bullish, then and the third wave is shorter than the first wave, there is a high chance, okay, all right, there's a high chance, okay, that the fifth wave will be shorter than the third wave. So suppose I see something like this. One example, I can draw it now. Okay, I'm finishing now. Suppose we were here. So this is suppose we have a first wave that has been extended. In fact, okay, suppose we have a first wave that has been extended. Okay, first wave went boom, 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 like this one. And then, okay, we have a second wave. And then you notice that, okay, George said that, okay, the third wave should not be the shortest. But the first warning that we see is that we will notice straight away that here suddenly the price pull back. Okay, suppose we were here, the price pull back like this because the wave count we are here, first wave, second wave we are here. Now we notice that the third wave is shorter than the first wave. Yes, the third wave can be shorter than the first wave, but should not be shorter than the first wave and the fifth wave together. That's the difference. The third wave can be shorter than the first wave. The third wave can be shorter than the fifth wave, but the third wave should not be shorter than both first wave and the fifth wave. This is what we are discussing here. So you will notice sometimes that the first wave is longer than the third wave, or you may notice that the fifth wave is longer than the third wave. But the third wave should not be the shortest wave, which means the third wave should not be shorter than the first and the fifth together. Okay? But it can be shorter than the first wave alone, or it can be shorter than the fifth wave alone, but it cannot be shorter than both the first and the fifth wave. So suppose we were counting our wave, we say first wave, second wave, third wave, and then we see like this, okay? and the fourth wave did not overlap it, what will go through your mind? Okay, what will go through your mind? All right? What will, think of it for a second. What will go through your mind? The first thing that should come to your mind, if this trend is normal, according to the wave principle, we are likely to see the fifth wave that will be shorter than the first wave. Okay, ladies and gentlemen, let's wrap it up. This is the end of this video. Okay, we can continue, we can go on and on interpreting the wave principle and discussing this, but it's better that I record another video and we go through this analysis. I will be recording another video and I will explain to traders why, okay, the fourth Elliott wave should not overlap the first Elliott wave. I hope you have learned something from this video also and we put it to use to make excellent trading decisions. Until the next time, enjoy yourself and be very happy. We are the TSTW 24 traders. Speak to you soon.